Most people who give to charity are leaving thousands of dollars on the table every single year. And the crazy part is, a lot of the time, they don't even know they're doing it. If you're someone who regularly gives to charity and you also own investments that have grown in value, you could be making one of the most costly charitable giving mistakes you can. This mistake could cost anywhere from a few thousand to hundreds of thousands, depending on how much charity you do each year. There's a simple strategy that can eliminate this tax burden and help you be a lot more efficient with your charitable giving. So the problem is what I call the double tax trap. So here's how it works. So a lot of generous families are going to follow the same pattern year after year. They do what's simple. Let's say they give $1,000 a month to charity. Very generous. Maybe they write a check or transfer cash from their bank account. It's simple. But at the same time, maybe later in the year, they sell some of their investments that have grown in value and cause some capital gains. So, whenever you sell an appreciated investment in a taxable account, you can trigger capital gains taxes. So, for example, if you bought a stock for $6,000 and now it's worth $12,000, you would pay capital gains taxes on that $6,000 gain. It could be around $2,000 or more to the IRS. So, in this example, you would have given $12,000 to charity and then also paid $2,000 to the government. So you're out $14,000, but your charitable impact was only 12. The result of this is that generous families keep overpaying their taxes every year, thinking this is just the cost of being charitable, when there's actually a simple way to eliminate this tax burden. I'm Bjorn Amundsen, a certified financial planner, and I've helped many families optimize their charitable giving strategies. Today, I want to show you exactly how you can escape from this double tax trap and keep more money in your pocket while supporting the things you care most about. My goal is that by the end of this video, you're going to understand exactly how you can save taxes while still giving to charity. These principles are really powerful, so once you understand them, it's going to help you figure out the best way to give to charity. The first concept you should know about is a direct stock donation. So instead of giving cash to charity, what you would do is gift appreciated investments directly to charity. So here's why this works so well. When you donate appreciated stock that you've held for more than a year, two things happen. First, you don't have to pay any capital gains on it because you never sold it. The stock goes from your account directly to the charity's account, and the charity doesn't pay any capital gains because they're a charity. They're a 501c3. So it allows us to bypass the capital gains tax on that. Second, you also still get to deduct the full market value of what you just gave to charity. So let's go back to our example. Instead of selling your $12,000 of stock and paying $2,000 of capital gains and then donating the $12,000 in cash, you could just donate the $12,000 of appreciated stock directly. And then you would have the same $12,000 charitable deduction, but you get to keep the $2,000 that you would have paid in taxes. So let me show you how this looks for a family. In this case, the family earns $250,000 a year, and they give $12,000 to charity. So in scenario one, you'll see their $250,000 of wages, and then we've got about $1,000 of taxable interest. We'll add that to the other side as well. And so in each case, they're making $250,000. But in scenario one, you can see they have $12,000 of long-term capital gains. And in scenario two, they gave those stocks directly to charity, bypassing the capital gains. That alone changes their taxes pretty significantly. You can see that in the first scenario, their overall tax bill is $40,600. But in the second scenario, it's $38,400. So just gifting that stock directly can save them about $2,000 in taxes. Over 10 years, if they did this every time, it could save about $20,000 in taxes while still giving all the same amount to charity. Now I can hear what you're saying. You're probably saying, but I already give to several organizations and maybe I don't even know where I want to give yet. And gosh, it seems really cumbersome to transfer all of these funds into these various charities. I don't know if it's worth the effort. Well, that's where a donor advised fund comes in. A donor advised fund is basically like a charitable investment account. You can donate your appreciated stock to the fund and get your immediate tax deduction, and then recommend distributions to specific charities. So, this gives you three really big tax advantages. First, you can just make one donation for tax purposes and then support multiple charities throughout the year. So maybe you give your $12,000 of appreciated stock at one point during the year and have checks going out monthly to all the charities you like to support. It helps you and makes your life real simple, and the charities still get the same monthly check that they normally get. The second advantage is you don't have to immediately decide where every dollar goes. You could take your time to research the charities or respond to any needs that might arise that you're not expecting later in the year. Third, the money in a donor advised fund can keep growing tax free until you decide to distribute it. That could potentially allow you to give even more. So here's another technique that you can use to multiply your tax saving. Instead of giving the same amount every year, you bunch multiple years of giving into one year and then give nothing the next year. So let's go back to our family who gives the $12,000 annually. Remember how they first were smart enough now to give the appreciated stock, but they have to get over this thing that we call the standard deduction. The standard deduction this year is $31,500 for a married couple filing jointly. So that means everyone who's married gets to deduct that much. There are three things that really count. First, there's medical expenses, but those medical expenses, you have to hit some thresholds with that. So I don't normally see a lot of medical expense deductions. Second is the taxes you pay to your state. This would include sales taxes, property taxes, income taxes, and you add all of those up. There formerly used to be a $10,000 cap on those. That cap is now changed to $40,000, subject to a phase out based on your income. The second thing you can deduct is your interest on your mortgage. And then the last is your charitable giving. So effectively, we're going to add up what you pay to your state, your mortgage interest, plus your charitable giving. As you can see here, with our example family, they had about $8,000 in taxes they paid to the state. Then they had about $10,000 of mortgage interest. And then they gave about $12,000 to charity. When we add all of that up, it turns out that in their case, the itemized deduction of all three of those things adds up to only $30,000. So in this case, they got no benefit for all of their charitable giving. And so they're going to just get the standard deduction of $31,500. So why is that? Well, if you add up all of those three things, it only added up to the $30,000. The standard deduction of $31,500 is higher, so congratulations, that's what you get to deduct. So let's have this family do something a little bit out of the ordinary. What they're going to do this year instead is they're going to have the same $8,000 to the state, the same mortgage, but then this year, instead of just giving $12,000, they'll give all of their 2025 giving and all of their 2026 giving. So they're going to give $24,000 this year instead. This is going to allow them to blow past the standard deduction of $31,500 and be all the way up to $42,000. So by prepaying their 2026 charitable giving into the donor advised fund, it gets them a much larger deduction. So now when we go and check on their taxes for their year, instead of their federal taxes being $40,600, they're only $36,000. And instead of their Minnesota taxes being $15,600, they're only $13,700. So that gives us about $7,000 worth of extra deductions, even though they're not giving any more to charity. They're just giving to charity in a more intelligent manner. So now that you understand how the double tax trap might be costing you thousands, you can use this information to make some more strategic decisions about your charitable giving. If you want to learn more about how we can help clients implement these advanced charitable giving strategies, Click the first link in the description below and schedule a call with me. We can discuss what your goals are and how we can help you make a bigger impact with what you have. Thanks for watching, and I'll see you on the next video.